Namaskar, this is Akhilesh Bhargava again. Welcome to Tidbits on Business and Finance with me. The share prices of small and mid-cap companies have been amidst a bloodbath in the year 2018. They have been collapsing and they will continue to collapse. Just since May 2018, the prices of these companies' shares have gone down by 10%. Their downward trend continues. Most of these shares today are at a discount of 40 to 50% below their peak prices. In other words, they are trading at half the peak prices. And if you were one of those investors who had bought these shares when they were at their peak, you would be a very troubled person at the moment. This bull run in the small and mid-cap companies started in the end of 2013, the beginning of 2014. In 2015, 16 and 17, they actually gave spectacular returns to their investors. In just 2017, the rise in prices in these scripts was at an average 50 to 60%, and the trend looked very, very bullish. A lot of investors entered the market. These spectacular gains were such that even the most conservative investor was attracted into investing in the shares of these small and medium cap companies. It looked like the golden India story was riding in the shares of these companies. People did not even bother to realize that the prices of these companies, the share prices of these companies, were completely devoid of any strong fundamental financial support. In other words, the share prices were completely cut away from what we call corporate fundamentals of sound financial performance. People were just entering, expecting that the bull run would just continue. The reverse is now happening. They are all in an exit mode. The primary reason why the prices have collapsed is what I told you. The share price was not supported by fundamentals. The corporates were actually, in the last 3 years, facing what I call a recession in earnings. They were not earning profits, and yet share prices were going up. At some point of time, reality was bound to dawn, and reality has come now. This was also a period when foreign investors were willing to pay a very huge premium for the India story. They are now not convinced. After 3 years of waiting and no improvement in the earnings of these companies, the foreign investors too are exiting. So the India story does not command a premium anymore. It is also at a discount, and that discount is of course reflected in the prices of the shares of these companies. The other reason, apart from the fundamentals not being strong, has been the fact that in the last 6 months, there have been numerous cases of auditors resigning. There have been numerous cases of auditors qualifying their audit reports. There have been numerous instances of auditors red flagging and telling the investors that they are not satisfied with the state of affairs of the companies. There have also been instances of violation of corporate governance. You take the case like Manpasand Beverages, Vakrangi, Atlanta Limited, even a rumor on Dilip Bilkon. In these instances, prices have collapsed by 40-50% in a matter of 2-3 months only because auditors resigned or auditors have red flagged their reports. The very financial statements of these companies have been suspect, and when the financial statements are suspect, shareholders are bound to lose faith in the management, they are bound to lose faith in the company, and that's bound to be reflected on the prices of the shares of the companies which we are witnessing at the moment. So apart from corporate earnings being absent, the quality of earnings or the quality of financial statements has also reflected on the share prices of these companies. It is because of these kind of developments of financial statements being suspect, corporate governance being violated, market volume still being very high in the shares, despite there being a disconnect between the price and the performance, that SEBI has also put a number of these shares in what they call additional market surveillance. Many shares are under surveillance by the SEBI guidelines, which means they attract 100% margin for trading in them. There are also restrictions on their price rise and price fall, which means people will not get an exit if they want to suddenly. And that has also discouraged seasoned investors. Seasoned investors, thanks to the additional measures of SEBI for the purpose of market surveillance, these seasoned investors have been exiting from the small and mid-cap companies and been investing in the blue chip companies. That also is a reason for a fall in their market prices. The other factors, of course, are India is now entering an election year. We are now in an election bound mode. And whenever a country gets into an election year, there is a certain amount of uncertainty and nervousness in the investors. And that reflects on the overall share prices on the stock market as we are seeing. The oil price rise, a stronger dollar, the India story now being suspected, our macroeconomic fundamentals looking to be weakening, the recent interest rate rise by the Reserve Bank are also other factors which are impacting the prices of these prices of these companies in an adverse manner. The primary reason, if you really ask me, is if you invest in the prices of shares if you invest in the shares of a company without even bothering to check whether the price and its corporate fundamentals match, you're bound to lose money. If not in the short run, certainly in the long run. And if you're bound to lose money heavily, because when the fundamentals are missing, you're bound to lose your capital. The company does not deserve the kind of price you invested in. And the worst sufferers, as I told you, are those who entered these shares when they were at a peak price. And the peak is now not going to come back. This is Akhilesh Bhargava signing off till we meet again. Namaskar.